the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hi there, welcome to the Property Pod, South Africa's premier property investor podcast. On this weekly show, which is also features on Moneyweb TV, our YouTube channel, we gain insider insights from leading executives, entrepreneurs and analysts in South Africa's dynamic property sector. Last week, we looked at the listed residential space and listed property counters covering the resi sector, as it were. This week, we're looking at real estate investment trust and the side of the market, which is quite a big sector on the JSE, how the sector's performed till the end of May, and recent developments as well as results. It's results season. Several counters have come out with their latest results. Joining me now on the podcast is Elston, the founder of Gold Section Capital, who's covered the sector listed property for over 2 decades. He has been on our podcast before, and it's good to welcome him back to the podcast. Gareth, welcome back.
Thank you very much, Suren. Great to be on again. Now,
you are one of the most outspoken analysts and commentators on the listed sector, which is quite refreshing. And you're not afraid to question deals and, be a little bit critical when you need to on results and that sort of thing. Now, before we go into the controversial or provocative questions, can you give us an update on how the listed sector has performed so far this year? Obviously, you have the Middle East conflict causing problems for all listed companies with the volatility in the markets. But we also recently had a interest rate hike, so that's not necessarily good news for the sector.
Yeah, no, it certainly doesn't help, Suren. But yeah, it's been an interesting year. I think we were all hoping that this year was going to be nice, smooth sailing again, and we'd see 3 rate cuts, and everything would look hunky dory, and we could just get down to business. But the markets have a very nasty way of smashing you down whenever you get a little too ahead of yourself and think only good things are coming. But that being said, we've had an interesting year. The last month was pretty sideways, really, for the all property index. It ended the month up 0.65%. So just under 1%, not really going anywhere. It's not really too much of a surprise. Luckily, I suppose we had the rate cut coming towards the end of the month, so that probably kept us afloat. But if we have a look at the second quarter, we've certainly had again thus far, because you just never know what might happen in the conflict areas when we are dealing with the Trump presidency and strange things that happen. Is thus far the second quarter is looking nice and positive. Now we're up by 6.45 for the quarter thus far. 1 month still to go. Which is a nice change from where, we ended the first quarter at, where we ended off at negative 5.32. So it's looking okay. Year to date, it's also again almost flat. It's 0.79% up for the all property. So it's been very up and down and quite a roller coaster for the year thus far.
Now, you talked roller coaster. I have my next question mentioned seesaw. Is that likely to continue? I know you don't have a crystal ball, but there's a lot of expectation on things settling in the Middle East. Is it fair to ask what's your expectation for the year performance? Is it pretty much going to be a seesaw, or are you hoping for positive territory?
It's quite difficult to call at the moment, and just because things are so unsettled, especially in the Middle East. And if we have a look at the end of March, we had the first kind of ceasefire announced, and the markets were hyper positive and everything looked great. And that lasted, I think, all of 24 hours before the air started going out again. And then, we're still negotiating, but bombing at the same time. So it's just not clear at the moment how long this is still going to carry on. Also, I think we haven't really seen the impacts coming through as much as they are probably going to. So, locally we're seeing the Reserve Bank cutting on expectations of inflation coming through, but we haven't really seen the impact yet of 2 months of diesel being incredibly expensive. Now we're banging in a 25 basis point rate cut. Things are probably going to get a little bit tighter locally, especially than we think. And it's going to be very similar in Europe and most of the other markets where South African REITs are operating. So I think it's going to be a little bit tougher than we had hoped. We're not seeing the exact effects yet, but they're not going to be pretty. I mean, even if the conflict ends this afternoon and everything is done, it takes a while for everything to normalize, and it can take quite a while, especially for oil prices to come down, to stabilize, for the oil to start flowing, for inflation to calm down. So it's probably not going to be as positive as we had hoped, and we're probably looking at sub 10% returns for this year with the information we have at the moment. Should it go worse, of course, we could be looking at best to be completely flat. At worst, we could have a negative year. But with the information we have at the moment, we probably still looking at, we should come out positive by the end of the year, but it's all subject to change.
Well, that's also subject to further interest rate hikes if things continue the way, if there's no resolution. Will this affect, if we see another 1 or 2 more hikes, will this bring conservativeness back into the sector, considering, with counters maybe being a bit cautious on deal making and, investing in their portfolios?
Well, potentially. I mean, it probably is going to make a few more of the generalist investors a little bit nervous about the sector again. But, if we have a look how this conflict's been going on for quite a while. During last month, you had Vukile doing a massive cap raise, literally off 3 bits of information. We're going to a new market. We're buying 3 assets. They're going to be in Italy, and we're going to get a 10% yield, and investors threw money at them. So they're not nervous yet by the looks of it. It's still quite a bit of appetite out there for listed property assets. But probably the generalists will probably start backing off a little bit more, which might make it a bit less frothy than we've seen for a while. But there's still a lot of appetite. And if we have a look at the cap raises again, also over the last two months or so, and the debt raises too, they've been very, very well supported and mostly oversubscribed by quite large margins. So we're not seeing it yet, but, bad news carries on long enough. Eventually, people do need to start closing those checkbooks, but that's not here yet.
Well, after COVID fallout, a lot of the REITs have got their balance sheets in a much stronger position and that sort of thing. Now, you went on to my next question, which is quite topical. Vukile has been one of the most active in the market over recent years. Latest capital raise, I think around 2.8 billion. You were a little bit provocative in your comments on LinkedIn that I saw where, Vukile has been very successful in Spain, but you're not so convinced about Italy. Can you share some insights on that? Your thoughts around the expansion into Italy? And is it going to be a bigger challenge, would you say? And are they up for the challenge considering what they've achieved in Spain?
Yeah, look, I think the company is definitely up for the challenge. They have a very good management team. They're very good at turning around assets. Italy is a different market to Spain in some regards. In some regards, it's quite similar in the regards, for example, of unemployment and especially youth unemployment. They're quite similar on that. Both those levels are pretty high. The main problem with Italy is that you have very low growth. It's starting to look a little bit better, but it's always very touchy in Italy as to whether you can get that growth really getting to any meaningful levels. You have a lot of political uncertainty there too when it comes to the courts as well. Italian courts are not exactly known for being quick and easy to navigate through. So it adds another layer of complexity. And also, it's a very regional economy as well. So, if you're looking at the south, it's not a great market for many things to look at. The north is a bit better. And even in the north, you need to make sure that you're looking at the right areas within it. So it's not going to be as easy. The plus is that, look, they do have local experience through Pradera that they have, and that will definitely help. So they're not going in blind, which is a big plus. And should they be able to get the assets that they're looking at, we don't have more information yet, which is, again, it's still, to me, I still find it quite bizarre that you have a capital raise of this size and you're given 3 little bits of information. This wouldn't fly in a European market or a North American market if you were looking to raise this quanta of money. You would have to give a lot more. So there's a lot of trust that I think Vukile has earned from the market through their delivery. And they've got to make sure that they carry on delivering that. So, this is, they really need to make sure that this time they carry on doing what they've been doing, which I think they've got a better than even chance of doing. It's a good team, as I said, so I think they'll do it, but it's not going to be as easy. Italy is a very different market in a European sense than the other markets that they've been in. So it'll be interesting to see how it goes, and very interesting to see what the assets actually are when they're announced. I think that's going to be really key.
Well, I asked Lawrence and Co for comment, and they said that more detail will come out at the upcoming results later this month. But just Giorgia Meloni, she's quite a successful and well-liked leader in Italy. I don't know the local situation, if she's getting a bit of pushback and may not be in power. But you talk lower growth. Generally speaking, when you have an innovative, very strong leader that drives the economy, things look a little bit better. Do you have any sense of how things are from that perspective on the Italian market?
Yeah, look, Italian politics is something else altogether. So probably for the last year or two, they've actually been quite stable in terms of their general history. I mean, you can go back, if you look at Italian politics over the years, and they've had years where they've had multiple governments in a single year, governments coming in, falling very quickly, being replaced. So it's not the most stable political dispensation in Europe, but at the moment it's been a lot more stable. So Meloni's definitely had a very big focus on getting Italy working again. So there's definitely a plus on that. So it's from a political leadership point of view, it's definitely looking better than it has been for many years. So it should be the sweet spot. But the problem with, Italy is they can change pretty quickly. And if we start to see inflation coming through again in Italy, we start to see potential rate hikes again in the Eurozone. These things are not going to be great for the Italian market too. And then you can start to see again potential populist and or more right-wing governments trying to come through in the market. So you just never know, but it's certainly not the most stable country if you've ever studied their politics. It's a fascinating area to study, but it's not stable. Yeah. But at the moment it has been, and I think for everyone's sake, we definitely hope that it remains stable. It would be very important.
Well, Italy, it's the World Cup month. Italy is not in the World Cup and Spain is. But Spain also hosts the next World Cup after the US, Canada, and Mexico. So that will be an uplift for the Spanish economy and Portuguese economy as well, because it's being co-hosted by Morocco. But Gareth, let's just move on a little bit. Obviously, Vukile has been one of the biggest capital raisers, but there have been other smaller players also doing some capital raises. I think Spear was one of them. It's not as high as last year. What's your expectations? A little bit more caution coming into the market following this interest rate hike and potentially more hikes.
Yeah, look, Spear I think is a unique proposition really within the market. They have a geographic focus on the Western Cape. The management team has been very good at executing on their strategy and their discipline. And they've been building, slowly and incrementally over the past few years to get to the size where they are now. They've really been very focused on delivering that. There's a good bench there. There's a very good experienced team. It's come along very well, and I think they'll probably carry on delivering on that. And that's I think what the discipline and the focus is that they've been able to do. But as with any of the local REITs, it's going to be with rates going up and the economy potentially under a bit more pressure. Everyone's going to be in the same boat as such. Spear probably in a better position than a lot of others because of where they operate. And also the structure they have. Their metrics are very good. There's not too much to worry about when looking at Spear. They'll just carry on, I think, doing what they've been doing, which is certainly a comfort for investors.
Okay. Now, another counter that you commented on following their recent results was Emira. Now, Emira sold quite a big portfolio a few years ago to Spear, in fact. They're the only fund that has exposure to the US listed property fund or SA REIT. But you expressed that, I don't know if I'm getting it 100% right, but my sense was that you believe that the group is becoming a bit too complicated and, with its holding of fellow SA REITs in the likes of SA Corporate and Octodec. Can you give me some thoughts on that? Emira itself is also owned by a majority stake by Castleview.
Yeah.
And James Templeton, not James Day, James Templeton, the former Emira CEO, seems to be driving a lot of that behind the scenes. But you kind of express the view that it's management on top of management. It's probably quite problematic for retail investors, and the liquidity of the stock is also affected. What are your thoughts generally? And they also are selling down in the US.
Yeah, look, so in my view is that capital decisions of those natures should really be made by the investor. If an investor is investing in Emira, they're investing in Emira. They're not investing in Emira and then expecting Emira to go and buy SA Corporate and Octodec. If they want exposure to SA Corporate and Octodec, they will allocate capital there themselves. Then again, you said you do have management on management, because you have Emira management that then manages a holding in Octodec, which has its own management and costs. So for me, I don't like, unless you're setting up your company as a fund of funds or a company that invests in other companies, that's fine. But if you're investing in a listed property company that's meant to be a property owning company, I'm not a fan from an investment point of view of listed companies that go and buy stakes in other listed companies. That's not, I think, what their key business should be. Their key business should be managing their property holdings. And if they find that they can't allocate the capital they have better into that portfolio, they should return that capital to their shareholders, who can then choose where they prefer to put that capital. But that's a view I have, and some people disagree with me, but I feel quite strongly on it, is that is the investor's choice of where that capital should be going, as opposed to just buying companies that are trading at discounts to NAV. Adding another company, if you're already at a discount to NAV, and then buying another company at a discount to NAV, is that going to fix your discount to NAV? Especially as it becomes potentially more and more liquid, I doubt it very seriously.
Now, results, it is results season. What stood out for you? I don't know if you want to comment on Emira further from a results perspective. They didn't have as strong a results as even maybe Octodec, but a big one was Redefine, and obviously Vukile is coming up, but there are other smaller counters that also release some results.
Yeah, look, so I think what we're seeing with results coming through from most of the companies that reported during last month is that the underlying businesses are doing very well. They are performing in line with expectations and guidance, and in a few cases exceeding those. So the underlying businesses are good and strong, which is great. So it's good to see. Hopefully they carry on, considering the fuel price hikes and interest rate hikes. We'll have to see whether that continues. But looking at the results that we've seen, is they have been very good. And we've seen increases in guidance as well. We find it a very good set of numbers. If you look at Octodec and Emira, both of those have continued moves to rationalize their portfolio. So they've managed to sell quite a lot, and Emira has managed to sell a huge amount. So that's got to be taken into account when looking at their results too, both locally and as you briefly mentioned as well, with the holdings that they had in the US holdings there too. So the results are good. The market probably, I think if we look at what these results delivered, we probably would have expected a far stronger return for the month. But just macro really is overwhelming the good news that we've had. But again, these results are the past now, and what's going to be the future. I'm pretty sure when we get the Vukile results coming through, they're going to be good. I'm not expecting anything negative or even slightly negative on that. But it's what are things going to look like 6 months from now? And I think they're going to be a little bit tighter than they have been for the previous 6 months.
And just lastly, quickly, Hyprop, they getting a little bit of Maz. Obviously, they tried to take over Maz in an almost hostile takeover last year, but they bought a property from Maz recently. They were stuck with a bit of money for a little while there when they raised that capital. So they were sitting on that cash. Does it surprise you they move to buy that mall in Eastern Europe? No,
I don't think it surprises me. I think they'd be looking for assets, and someone who would be selling assets is going to be Mass. So it's good to see that they moved away from probably what was a bit of a negative to and fro between the two companies when we had that corporate action going on, and the focus on getting a deal done. So it should be positive, but it's going to be quite difficult, for Hyprop to get to proper scale on the Eastern European operations there, which is I think, important for them to do. It probably would have been better if they've managed to do the deal that they had hoped and then have moved on from that. But I think they definitely need to build their portfolio. So getting hold of assets, and if we get them at the right price, that's obviously great. It'll work out, I think, well for them, but it's going to take time to get that to the scale that it needs to be. And then, of course, they've been trying to get rid of several assets here. We had the fallout from the Hyde Park sale that they didn't go through, unfortunately. So they've had to, I think, go back to the drawing board on that. But in terms of their general portfolio, and especially the new assets they have in the Western Cape, and potentially getting the whole of Canal Walk as well, will also be pretty positive for the company too. So quite a few levers that they are able to pull there at the moment. And should they get them all right, I think they would be looking pretty good going forward.
Well, that is a big deal, considering a similar move by Attack to get that remaining 20% a few years ago of Mall of Africa from Atterbury. But Gareth, we probably can talk for another half hour. I appreciate your time on the pod. It's insightful as always. Thanks for your time. That was Gareth Elston, the founder and boss of Gold Section Capital, and he's an analyst and commentator on the listed property sector in South Africa.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.